In this video, we're going to discuss the difference between a sales type lease and an operating lease from the perspective of the lessor. So with a sales type lease, you're going to be recognizing sales revenue and cost of goods sold at the outset of the lease. So you're actually, by recognizing cost of goods sold, you're also going to be crediting inventory, and you're actually getting the leased asset off of your balance sheet as the lessor. Then you're going to be recording a lease receivable, and then as interest effectively accrues on that lease receivable, which you're going to use an effective interest table to calculate, you're going to be increasing the receivable, and then you reduce the receivable whenever you receive a payment from the lessee. And then at the end of the lease, you're going to be booking the asset back to inventory because you're being given the asset back to you, whether it's a machine or whatever, it's being given back to you by the lessee at the end of the lease, and so you put it back on your inventory. Now, operating lease is very different for a lessor. So if a lease is categorized as an operating lease, you're not going to remove the asset from your books. So that means you're not going to have cost of goods sold. You're not going to have sales revenue. We're not going to do that at all. What you're instead going to do is each time you receive cash, you're going to be recognizing either unearned revenue or lease revenue, depending on what point in the period that you receive the cash. If it's beginning of the year payments that you receive the cash, you'll recognize unearned revenue. And then at the end of the year, after you've earned the revenue, then you'll recognize the lease revenue. So it's not like you recognize sales revenue up front and then have interest revenue on the receivable throughout the lease. It doesn't work like that. You're instead saying, well, we don't have any sales revenue up front. We're not even removing the asset from our books. We don't have cost of goods sold, any of that. We're just going to recognize lease revenue in each period as it's earned. And because we're not removing the asset from the books when it's an operating lease, we're going to depreciate the asset over its economic life, assuming that it is a depreciable asset. So I want to give you a fact pattern. It's the same fact pattern we've used in the other videos for operating, finance, sales type leases. So I'm just going to stick with that. So let's say that your company, you're the lessor, and you lease a truck to a lessee for 3 years. The truck's expected to have residual value of $15,000 at the end of the lease, and you're going to receive lease payments of $20,000 a year at the beginning of each year. Okay, so 3 years, three periods, you get $20,000 three times. Your implicit interest rate is 6%. We can use that to calculate the present value of the residual value, that 15 grand, that's $12,594, and then the present value of the lease payments, the three $20,000 payments, they're an annuity due because you're receiving at the beginning of each period. It's $56,668. If you add those two together, that gives you a fair value of this truck of $69,262. Okay. Now, the truck is expected to have a useful economic life of 10 years. Why is that important? Well, for the operating method, we're going to be depreciating this truck. And so we need to know the useful economic life. You don't just depreciate it over the lease term of 3 years. You're going to keep the asset under the operating lease method, and you're going to depreciate it over its entire economic life, okay, which is longer than the lease period. Now, your company's cost basis in the truck, which we'll also need to know to calculate the depreciation for the operating method, is $50,000, and the salvage value of the truck is expected to be 0. Now, I know that sounds weird. You got like residual value up here, and that's the salvage value here. The salvage value is at the end of the 10-year period. Okay, so that's at the end of 10 years. This residual value is at the end of the 3 years. With and so don't worry too much about the differences there. Basically, the residual value we're going to use with the finance method, and we're going to be using the salvage value to do depreciation with the operating method. So don't worry too much about the differences there. Okay. So on the left, we'll have the sales type lease, and on the right, we'll have the operating lease. First thing you'll notice is that we have an effective interest table with a sales type lease, whereas we do not have to make an effective interest table with an operating lease. Okay, so the way the effective interest table works, we set it up. We say, okay, we have initially this fair value, the present value of the lease payments, and the present value of the residual value. They're going to be the lease receivable at the beginning, $69,262. I don't want to get too much in the differences over the guaranteed and unguaranteed residual value. We'll talk about that in another video. But in this video, assume the residual value and the lease payments, the present value of each. That's the lease receivable, $69,262. Now, there's a $20,000 payment recognized immediately, so it goes down to $49,262. And then we're going to recognize interest on a lease receivable times 0.06. That was the implicit interest rate. Gives us $2,956, and that's the interest. And then we're going to net these two. We're going to net these two to see the reduction in the receivable from 49,262 minus 17,044 gives us 32,218. I talked about this in the sales type lease video, so I'm not going to go through the entire table in the interest of time. Now, when you book, or when you originally, at the outset of this lease for the sales type lease, you're going to debit lease receivable and credit sales revenue. Again, for that 69,262. You're also going to get the asset off your books at $50,000. You say, okay, we're going to debit cost of goods sold, and then we're going to credit inventory. Okay, that's just assuming that's what this asset's cost basis was to you. Okay, now we've got, okay, our first time that we get to $20,000 from the lessee. In each case, we're going to debit cash, whether it's operating or sales type lease, right? But with the sales type, we're going to reduce the receivable. Because remember, we recognize that receivable up front and we booked the sale up front. And now we're reducing that receivable. But the corresponding credit for the operating lease is unearned lease revenue. Because we don't have a receivable with the operating lease method. There's no receivable that we have to reduce. Okay. Now, at the end of the period, for the operating lease method, now we say we debit the unearned lease revenue because now it's been earned, right? After 1 year, it's been earned. We credit lease revenue. So this lease revenue will go to the income statement. And then depreciation expense, we had $50,000 cost basis, 0 salvage value. We're depreciating over its economic life of 10 years. So 50,000 divided by 10 goes 5,000 a year if we did straight line depreciation. So there's $5,000 depreciation expense, 5,000 accumulated depreciation. Okay, now with the sales type lease, we don't have any depreciation. Why? Because we got the asset off our books. Remember, we debited cost of goods sold and credit inventory. This thing's gone. Okay, so we're not going to depreciate something that we don't even have on our balance sheet. Okay, what we do have is we have a lease receivable, and we recognize that we had some interest on that lease receivable, and so we're going to credit interest revenue, and then that's going to increase the lease receivable. So interest revenue increases the lease receivable, payments received reduce the lease receivable, and then we follow the same pattern. The next time, so we get cash, we reduce the receivable. But for the operating method, with the corresponding thing to cash, we credit unearned lease revenue. Then we earn the lease revenue at the end of the year. We get $20,000 lease revenue. Every period is $20,000 lease revenue and $5,000 depreciation expense. Pretty simple for the operating method. Now the interest revenue is lower now for the finance method than it was the prior period. And the reason is that the lease receivable goes down each period. It decreases, right? And so if the lease receivable decreases, the interest on the lease receivable will decrease as well because we're taking the interest, we're calculating 0.06 by a smaller and smaller amount each period, okay? So we recognize interest revenue, 1933, and then we increase the lease receivable. Now we go and we say, all right, the final payment, we do basically the same, only the interest revenue is going to be $849. Now it's even smaller for the finance method. The operating method, we have the exact same journal entries. We have the same journal entries every time for the operating method. Okay, we're good. 20,000 lease revenue, 5,000 depreciation expense. One thing to note is, okay, now we're done recognizing lease revenue for this 3-year lease with the operating method, but we will continue to depreciate this asset because the asset is going to have an economic life of 10 years. The lease term was 3 years. So we still have 7 more years of recognizing depreciation. That's not associated with this lease. That's just because we have this asset and we're going to continue to depreciate it. Okay. Now, for the finance type, we also have one additional journal entry here for the finance type lease, which is when we get the asset back. When we get the asset back, remember, we took the asset off our books to begin with. We debited cost of goods sold and credited inventory. So now the lessee gives us the asset back. We had assumed that it would have residual value at the end of 3 years of $15,000. So then we debit inventory for $15,000, and then we credit lease receivable for $15,000. And at this point, the lease receivable will have a value of 0. Okay, and there's no corresponding entry like that for the operating lease approach because we never got the asset out of our books, right? We never went and debited cost of goods sold and credit inventory. We didn't do that. All we did was just keep the asset on our books and depreciate it over time.